Every 6 years on average, the economy goes into reverse. Markets crash, portfolios shrink, and panic spreads like wildfire. But while most investors watch their wealth evaporate, a select few actually thrive during these downturns. The difference isn't luck or insider knowledge. It's strategy. The kind of strategy that turns economic chaos into opportunity and transforms fear into financial security. The foundation of recession-proof investing. Since 1948, the United States has weathered 12 recessions. That means anyone who starts investing at 25 will likely experience 6 or 7 economic downturns before retirement. These aren't anomalies or black swan events. They're predictable patterns in the economic cycle, as natural as the changing seasons. The question isn't whether another recession will come. The question is whether portfolios are built to survive when it does. Traditional investing wisdom crumbles during recessions. The stocks that soared during boom times often plummet first and hardest when the economy contracts. Growth companies with high valuations and minimal profits become liability magnets. Speculative investments that promised quick returns vanish overnight. This is where most investors make their fatal mistake. They build portfolios designed for sunny days, then scramble when storms arrive. The winning approach flips this thinking entirely. Instead of reacting to recessions, smart investors prepare for them constantly. They understand that recession-resistant portfolios aren't built during downturns. They're constructed during the good times, when everyone else is chasing maximum returns and ignoring maximum risk. High-quality stocks form the bedrock of this approach. These aren't the flashy tech startups or viral meme stocks that dominate headlines. They're companies with bulletproof balance sheets, minimal debt, positive earnings, and strong cash flow. When economic turbulence hits, these businesses have the financial cushions to absorb shocks that destroy weaker competitors. Their stock prices might dip temporarily, but their fundamental strength keeps them viable while others collapse. Defensive sectors provide another layer of protection. Consumer staples, healthcare, and utilities aren't sexy investments. Nobody gets excited about toilet paper companies or electric providers. But that's exactly why they work during recessions. People still need groceries when unemployment rises. Hospitals stay busy regardless of economic conditions. Electricity bills get paid even when budgets tighten. These sectors generate steady revenue streams that persist through economic contractions, making them essential components of recession-resistant portfolios. The data backs this up consistently. During past recessions, defensive sectors significantly outperformed the broader market. While overall stock indexes cratered, companies providing essential goods and services maintained stability. This pattern repeats across decades of economic cycles, providing investors with a reliable playbook for navigating downturns. The power of strategic timing and diversification. Dollar cost averaging represents one of the most powerful yet underutilized strategies for recession survival. The concept is deceptively simple. Instead of investing lump sums all at once, investors commit fixed amounts at regular intervals regardless of market conditions. When prices drop, those fixed amounts buy more shares. When prices rise, they buy fewer. Over time, this approach smooths out the volatile entry points that devastate portfolios during market crashes. During the Great Recession, this strategy proved its worth dramatically. An investor who dollar-cost averaged into balanced funds throughout the downturn accumulated significantly more shares than someone who invested everything at the market peak. When recovery came, those extra shares generated substantially higher returns. The same pattern emerged during the dot-com crash and the pandemic-induced market collapse. Consistent investing during downturns positions portfolios for explosive growth during recoveries. The psychological benefits matter just as much as the financial ones. Market volatility triggers powerful emotional responses. Fear drives investors to sell at the worst possible moments, locking in devastating losses right before recoveries begin. Dollar cost averaging removes emotion from the equation. It creates a systematic approach that continues regardless of headlines, analyst predictions, or gut feelings. This discipline prevents the panic selling that destroys wealth during recessions. Research spanning decades confirms that markets trend upward over long periods despite periodic crashes. Missing just the 10 best days in the market over a 30 year period can cut returns by more than half. The problem is those best days often come immediately after the worst crashes, when fear is highest and selling pressure peaks. Investors who flee during downturns miss the explosive rebounds that follow, permanently damaging their long-term returns. Diversification amplifies these benefits exponentially. Spreading investments across multiple asset classes reduces the impact of any single position cratering. When stocks plunge, high-quality bonds often rise as investors flee to safety. When certain sectors collapse, others remain stable or even thrive. This balance doesn't eliminate risk, but it transforms portfolio volatility from life-threatening to manageable. Building your financial fortress. Even the most perfectly constructed investment portfolio can't protect against every recession risk. Job loss, medical emergencies, and unexpected expenses strike regardless of portfolio performance. This is where emergency funds become absolutely critical to recession survival. Financial experts traditionally recommended 3 to 6 months of living expenses in emergency savings. Recent economic volatility has shifted this guidance upward. Many now suggest 6 to 12 months of expenses, acknowledging that modern recessions can trigger prolonged unemployment and cascading financial challenges that shorter cushions can't absorb. Research from major financial institutions reveals that even modest emergency funds dramatically improve financial well-being. A reserve of just $2,000 can boost financial security by more than 20%. Larger funds provide exponentially greater peace of mind and practical protection. They prevent the desperate moves that destroy finances during crisis. Selling investments at market bottoms, racking up high-interest credit card debt, or depleting retirement accounts early all stem from inadequate cash reserves. The location of these funds matters as much as their size. Emergency money needs immediate accessibility without penalties or market risk. High-yield savings accounts provide the ideal combination of safety, liquidity, and returns. They offer FDIC insurance protecting deposits up to $250,000, instant access when emergencies strike, and interest rates that at least partially offset inflation. Beyond emergency funds, strategic bond allocation provides additional recession protection. United States Treasury bonds have delivered positive returns in every recession since 1950. When economic activity contracts, the Federal Reserve typically slashes interest rates to stimulate growth. This creates a favorable environment for existing bonds, which increase in value as new bonds offer lower yields. High-quality corporate bonds from financially sound companies offer similar benefits with slightly higher returns. Dividend-paying stocks create income streams that persist through market downturns. Companies with long histories of consistent dividend payments demonstrate financial strength and commitment to shareholders. During recessions, these dividends provide actual cash returns even when stock prices decline. This income can cover living expenses, fund additional investments at discounted prices, or simply provide psychological comfort during volatile periods. The ultimate recession-proof strategy combines all these elements into a cohesive whole. Quality stocks provide long-term growth potential. Defensive sectors offer stability during contractions. Dollar-cost averaging ensures consistent investing through all market conditions. Diversification spreads risk across multiple asset classes. Emergency funds handle short-term crises. Bonds and dividend stocks generate income regardless of market direction. This approach isn't glamorous. It doesn't promise overnight wealth or triple-digit returns. It won't generate exciting stories at dinner parties or viral social media posts. But it works. Through 12 recessions and counting, these principles have protected wealth, generated returns, and provided financial security when chaos reigns. The next recession is coming. That's not pessimism. That's economics. The average cycle suggests it could arrive within the next few years, though exact timing remains unknowable. What matters isn't predicting when it happens. What matters is being ready when it does. Building recession-resistant portfolios takes time, discipline, and patience. The ideal moment to start was yesterday. The second best moment is right now.